Welcome to tonight's Startup Fundraising during Covid-19 event with Stanford Angels and Entrepreneurs Midwest. I'm Sheila Proeve, MS 2003, co-president of the group and one of the moderators this evening. We're excited to have 3 alumni founders who have navigated the pandemic extremely well. We have Jaclyn from New York, Brian from Chicago, and Alan from Palo Alto. Also, thanks to you, our audience, for joining from across the country and world. We appreciate your curiosity and questions that have guided this event. Our group's mission is to enrich, educate, and connect the Stanford startup community in the country's mighty middle. Stanford has produced the most startup founders of any school, but entrepreneurs often face a lonely journey, which for some has only intensified during the pandemic. We've strengthened the community through social and educational programming around entrepreneurship. We also facilitate introductions between founders and angels across the country with our sister chapters in the Bay Area and SoCal. Feel free to ask additional questions for the panelists and upvote them. Alex Montalbini, MS 2008 and co-president of the group, will moderate those in the later half. Now, I'd like to introduce our panelists.
Alan Chiu from Palo Alto. Alan is the co-founder and CEO of Enya.ai, a confidential computing startup that helps companies protect privacy and minimize data liability while generating insights. Enya, trusted by millions of users, developed the advanced COVID checker Fever IQ and raised an oversubscribed seed round this summer. Alan, who is also a serial entrepreneur and partner at Exceed Capital, graduated from Stanford's Graduate School of Business in 2011. He's co-president of the Stanford Angels and Entrepreneurs chapter in the Bay Area and on the board of the Stanford GSB Alumni Association. Next up, we have Brian Barnes from Chicago. Brian is the founder and CEO of M1 Finance, a company in the personal finance technology and robo-advisory space. M1 Finance raised $33 million in Series B funding this June, led by Left Lane Capital, Jump Capital, and Clock Tower Technology Ventures. M1 surpassed 1 billion assets under management on its platform in February 2020, beating Acorns, Betterment, and Wealthfront on reaching this milestone. And in 6 months since, M1 doubled assets under management to $2 billion. Brian graduated from Stanford University in 2012 and has been immersed in personal investing since 5th grade. Next up, Jaclyn Chen from New York. Jaclyn is the founder and CEO of Benepass, a modern employee benefits card provider whose mission is to help companies take better care of their employees. The company graduated Y Combinator in winter 2020 and then raised a $2.4 million seed round led by Gradient Ventures. Jaclyn graduated from Stanford GSB in 2019. Earlier in her career, she worked at TPG Capital and Goldman Sachs.
Let's kick off the discussion. Give us a little more background. What's your company's history? How did your original idea evolve? Jaclyn, would you like to start off?
Thanks for having me, Sheila. Excited to talk with everyone today. I started my career in more like financial services, professional services. So I was an investment banker and late stage private equity investor. My dream was always to have a company of my own. And so that's why I went to business school in the first place. So spent basically, 2 years at school thinking of various business ideas and wanting to meet a co-founder. None of those actually came together until, frankly, towards the end. So when I left the GSB, I had a business idea around improving benefits distribution by using financial technology, particularly being able to issue credit cards via API and controlling and authenticating the transactions. So the company came together. That was kind of my half-baked idea once I left the GSB. My two co-founders are both friends of friends from my GSB network. They're former Google engineers, and we started prototyping the company last fall, applied to Y Combinator, and got in through to Y Combinator, which then kind of, the rest is the last crazy 6 months. That's been since the case. But really, I mean, I think we're using in HR, oftentimes you have a bunch of different tools, and what is a centralized purchasing process, but very individualized distribution. And what that means is it creates a lot of paperwork for the HR and people ops team. And so we're using, kind of modern fintech tools to hopefully be able to solve that pain point for HR and people ops teams.
Okay, great, thanks. How about Brian?
Yeah, so I think the M1 journey was created sort of a personal passion project as well as professional interest leading up to it. And so I was fortunate enough as a young kid to be shown a brokerage account sort of 10, 11 years old and just immediately captivated by the whole notion of investing and the ability to, take a problem, take a company, see what they're doing, place a high conviction bet behind it. If you're right, you made money; wrong, you lost money, and just became sort of the personal finance nerd from a pretty young age. So did that middle school, high school, and college, undergrad at Stanford, majored in econ and math while there, did a short stint at a equity hedge fund doing research for them, and then management consulting prior to starting M1. It's funny, like while I was at Stanford, I wanted nothing to do with startups. If anything, just sort of rolled my eyes with some of the commentary in the sphere. The second that you get into corporate bureaucracy, all you want to do is leave and get back to startups and take a big swing at things and make an impact. So knew I wanted to do something more entrepreneurial, and really creating M1 was the personal finance account I wish existed that I didn't see out in the marketplace and didn't see developing. And so we started building that. We launched a free automated investing platform, then built a low-cost borrowing line of credit, and then a high-yield checking account, all integrated and lets you manage your money in very intuitive, powerful ways. Company has been around for about 5 years. We're now 80 people in Chicago. We closed the $33 million fundraise in June. We're about to announce another big fundraise soon. And so, it's been a fun 5 years and enjoying what we're doing.
Great. Alan?
Data privacy has always mattered a lot to me. Having born and grown up partly in Hong Kong and seeing what's happening in that part of the world, it's becoming increasingly clear that without privacy, there's really no freedom. So when my co-founder and Stanford professor Jan Lepard came to me and wanted to work on a venture around data privacy together, I jumped at the opportunity. And what we've done since then is we've created an API that has democratized access to a number of somewhat sophisticated and hard to understand cryptographic techniques. And we've made it super easy for any developers to build websites and mobile apps that can to capture insights from sensitive data without being exposed to it, which on one hand protects end user privacy, but at the same time also actually reduces the data liability of the companies that are analyzing the sensitive data elements. And we've done it in a way that doesn't require the developers to understand anything about cryptography at all. So really taking the latest cryptographic research that's been brewing in academia and making it widely available to any developers out there. And when COVID happened, we crystallized a product called Fever.IQ on the Enya confidential computing platform, where we use our own technology to start collecting and analyzing COVID symptoms from around the world. And by now there are more than 4 million people who are using this secure computation network to learn about the COVID symptoms and the risk of contracting COVID. And there are businesses and schools using the risk classifier that we have developed to help keep their people safe.
Awesome, awesome. So where and when did you start looking for potential investors? And especially in these times, how do you find and build relationships with them? Alan, would you like to start this time?
Yeah, I'll jump into that. Before founding Enya, I had spent a number of years as a seed stage investor as partner at XC Capital. And so I had built up a network of investors over the years. But interestingly, during this fundraising process, it's still amazing how much value there is in leveraging not just the investors who are close to you, but also a loose network. Because the investors I had got to know over the years, many of them have been successful and therefore have started managing more and more capital in their funds. So they've moved towards later stage investments. Whereas when we went out to fundraise, we were really looking for a second seed to accelerate, because we saw that FIFA IQ started getting traction. So we wanted to raise more capital to invest in growth and accelerate our our sprint towards our Series A. And so a lot of the investors that I had gotten to know over the years, actually what we were doing wasn't a great fit for them. But because of these relationships, we were able to, one, get feedback on what kind of milestones we needed to shoot for in terms of our Series A, but also got a lot of valuable introductions to earlier stage investors that ended up coming into the round.
Great. Jacqueline, can you share your story?
Yeah. Going through Y Combinator, I think, is a pretty unique experience in terms of fundraising. I wouldn't, it's probably dissimilar to other fundraising processes in that, and I'll make the comparison maybe to like recruiting or on-campus recruiting, where, you know, going through YC is as if, like, I think you bring all your investors on the same timeline. So there's demo day, and then there's the few weeks after demo day. So we were able to fundraise fairly efficiently. You obviously pay a price to be in YC, as in they take equity at a certain valuation that is lower than, you know, perhaps what you can get after. But what it meant for us was, after demo day, I probably met, and this was right around when COVID hit, and so everything was immediately going to Zoom. I didn't do a ton of networking or talking to investors before, because we got the advice of just, like, you know, try and build and grow your company at the seed stage. And then in the 3 weeks after demo day in March, I think I probably talked to 80 or 90 seed investors just back to back on Zoom meetings. And then when we were able to secure our lead investor, then we got kind of other smaller institutional large angel checks that kind of filled in the rest of the round. So we didn't raise any money before we took YC's money, and then we have our seed round. So we didn't do kind of a pre-seed or angel round. So I guess that was the path that we took, which was, you know, you pay the price to be a part of Y Combinator, but then as a result, their biggest, I guess, pro is the fact that they can deliver you this highly efficient seed fundraising process.
And it sounds like you'd say, make Zoom your best friend.
You learn quickly. I've not met any of my investors in person. I've not met half of my team, our employees, in person, because we've been kind of a post-COVID business, if you will.
Okay, awesome. Great. Brian, how about you?
Yeah, so I've been doing M1 for 5 years, which is both short amount of time and very long amount of time, depending on the lens that you do it. And in some sense, have gone through 3 fundraising events, and now this is we are about to announce our 4th. And so we raised 9 million seed, 12.5 A, 33 B, and have our upcoming C that we'll announce. I think over like 5 years, you're even if you're putting together like a structured process for the fundraising, the CEO's job is sort of always recruiting, always fundraising. You have to capitalize the business and make sure that it has the resources that it needs to succeed and excel. And so, you know, over the last 5 years, I couldn't count how many conversations with different investors at different stages. What they're looking for in the progression moves up. I would say for the Series B that we concluded in June, we really sort of like hit the streets with a formalized process sort of February and March, but it was all talking to investors that we had relationships with built over the past several years. So it definitely didn't start in that capacity. It was just much more of here's the produced material to dig in a much more like fulsome fashion. And then we had a term sheet by end of March. Diligence took maybe a month and a half, and then the deal was closed.
Okay, great. So Brian, reflecting on, since you've raised several rounds for M1, reflecting on that, what would you say was the most important aspect of your company that investors looked at during this last fundraising round?
Yeah, so what they're looking at changes pretty dramatically as the company progresses. That early on, there's really not much to gauge. It's really the idea, the initial team, any demonstrated traction historically and the like. And so, really trying to, you're taking a little bit more of a leap of faith. As the company progresses, it becomes much more on the fundamentals and traction of the business. And so, M1 always was pitching this comprehensive, cohesive personal finance platform, combining digital banking and digital brokerage into one integrated platform that's better than either. And by our A, we had built it, and so people started using it. By our B, we had the $1 billion on the platform, and sort of in startup speak, that product market fit. It was really big enough market, sizable traction, actual revenue model, and the ability to absorb and put reasonable sums of money to work. That can you invest this $33 million at a high enough rate to get the venture returns that everyone's looking for?
Okay, great. How about Jacqueline? Could you share what was the most important aspect of your company to investors?
I think it was team, and it was just rough sense of the idea. Especially at the seed stage, we had some semblance of traction. So we had a few smaller companies using our product early on. And that was pretty much all the track. I mean, we didn't have any sort of real MRR or ARR to report. I think it helped that my two co-founders, so Gradient Ventures is Google's early stage venture fund. So I think it also helped that my two co-founders are former Google engineers in terms of, reference checking and team. But I'd imagine, in terms of idea, selling employee benefits as COVID was hitting was probably not even the best space to be in, kind of given, how small businesses were doing at the time. But I think our investor just really got the pain point that we were solving, had understood it from previous companies that he was at. And so it frankly was probably a lot of his gut.
Okay, good. And Alan, since you have raised funds for other companies in the past, maybe can you compare and contrast a little bit what elements changed in terms of what investors looked at in your company before deciding to invest?
Certainly, a lot of them were looking at the relevance of what we're building during COVID and also post-COVID. What's the story now and also going forward? And ideally, they're looking for businesses that are benefiting from the changing social norms or changing work patterns as a result of the pandemic. And what really helped us was this heightened sensitivity around personal privacy, especially when the debate around contact tracing was going on, where there was this dilemma between personal privacy and public health interests. And there was a lot of pressure on individuals to give up their personal privacy in the interest of public health. And there's a lot of resistance to that, but people didn't feel like there was really a solution. It was one or the other. And so we came into the conversation with our solution, offering the best of both worlds, where you can protect personal privacy while still addressing public health interests. And so that caught investors' attention, and it's certainly a story that will continue to be relevant going forward, as increasingly more and more jurisdictions are adopting GDPR-like privacy regulations, and so the more sensitive data a company ends up collecting, the higher compliance costs they end up incurring, and the more time and effort they'll need to invest in protecting the sensitive data. So using Enya to analyze the data instead of collecting everything that you can really helps these companies to over time move their data story towards a world that is much more protective of privacy. And so that's the story that resonated with investors.
Okay, great. So now could you touch on a little bit of how you think COVID impacted your company's valuation and the expectations on returns? Brian, do you want to start out?
Yeah, so I think there's multitude of effects, and I think there's still an ongoing question of what does the world look like in 6 months, 12 months, 18 months from here on out. And the nice thing about the industry that we're in, it's personal finance. It's really evergreen. People need great financial tools now, they need them in 5 years, 10 years, 15 years. And so you can really build like a sustainable, durable company that can last decades or, centuries. Like all the big name banks and the like are, multi-100-year-old institutions. And so the nice thing, like there's a marketplace to support the size of business that would drive the venture returns. I would say COVID accelerated what we think is like the digitization and the platform appeal of all the finances, that a like disproportionate share of people's money is still in mutual funds with advisors and the like. And there is a thought that that's going to shift to more digital platforms over the foreseeable future as like the younger cohorts generate wealth, they inherit wealth from the older generations and the like. And so, I would say that COVID was actually tailwind for us. It was an accelerant where, the market was in the news every day. People were looking for different finance options. The like signups and net deposits coming onto the platform were at all-time highs. And so it did accelerate our business. That being said, we have 2 billion, which is like meaningful for a fintech company compared to the incumbents. We're still a drop in the bucket. So, we have a long way to go. And I think we think much more long-term and generational shift of, are we the right platform over the next 5, 10, 15 years versus, are we capitalizing on a 6-month time window of global crazy pandemic?
Okay, great answer. Thanks. Jacqueline, could you maybe share a bit on valuations, especially very early stage companies?
Yeah. Early stage company valuations are completely made up. I mean, there's no valuation off of a real number. It's sort of a give and get, and it's not like price off of multiples, as far as I understand. So I think what we got was a very quote unquote average outcome among Y Combinator companies, which depending on which seed or early stage venture investor you might consider to be, high or low. People have opinions about that. I think COVID overall has actually ended up being a tailwind for our business, as a lot of companies have gone from obviously office to remote. So there's been, increased repurposing of budget from like in-office perks and benefits to distributed. And for our startup, again, like the TAM for employee benefits is significant. And it was kind of scary at the beginning when lots of companies were announcing layoffs and things like that. But for our startup to just start carving the path in this market, we just need to be able to sell to the companies that are doing well. And some of our largest customers that we're onboarding right now are completely rethinking their office policy. And that's why they're using us. And so we think of the next few years in terms of what are the customers that we can capture and they're doing well. And then I guess the global macro, what does this mean for companies and offices and perks and benefits? That's, I think in 5 years, that'll be frankly, our company will look different, and the issues that we face in terms of customer acquisition will be pretty different by then.
Okay, thank you. And Alan, maybe you can also bring in your perspective from Exceed Capital on valuations and the impact COVID brings to them.
Mm-hmm, mm-hmm. Yeah, so I think the companies that are able to raise a round during this time, they haven't really seen the valuations being negatively impacted. In fact, some of those that have where their growth has been accelerated because of the pandemic would actually have seen their valuation gone up, not down. I think the companies that have been negatively impacted, they probably would have had challenges raising a round even, and therefore you won't even see those valuation numbers come up. So I think the rounds that did close ended up raising at a fair or even higher than originally anticipated level of valuation.
Okay. Now, in terms of logistics, so how long did it take you to close the last funding round, and how many no's versus yeses did you experience?
I can start with that because I track these things biannually. It took us 4 weeks to close our round. I spoke with roughly 50 investors. 11 of them came into the round, and another 10 of them wanted to continue engaging, and they expressed interest in doing our Series A or being a part of our next round.
Seed fundraising is a bit more of a rolling process. So the way YCs normally do it is you sign safes, and so it's not like a priced round with who's in or who's out. You can kind of do it on a rolling basis. It ended up that our lead investor wanted to do a priced seed round, so it became this. It was starting a rolling process, and then it became kind of a fixed round. I would say we talked to, I think I had like 90 phone calls. I would say I probably only got a definitive answer, yes or no. And then people ghosting you is effectively no, right? So I probably had 2/3 people who just stopped responding, 1/3 of people who engaged in some sort of way. And then we just needed one major yes. And that was the first, and that ended up, they led our round, and it was an easy close after that. I would say it took about 2 weeks to like arrange to get our first like major yes, and then it took about 4 weeks of legal to finish and get the money in the bank.
Okay, thank you. And Brian, how about you?
Yeah, so M1 started off the year really hot. We had like a fantastic January and February, and we were really just anticipating like, okay, we're going to go start the fundraising process sort of end of March, early April, and it's going to be fun, and we're going to name our price. And then obviously like floor dropped, and we were sort of scrambling to figure things out. The nice thing is we had, like I mentioned, we had a lot of relationships that we built up over time. And so there was a lot of ambiguity in the air, and we were even wondering, do we go raise? Do we wait? Do we bridge the round with a short amount of money? We ultimately we probably had, 10 notable companies that could write the lead check that we're having conversations, and echoing Jaclyn's statements, VCs are incredibly good about like not ever saying the word no. It's always, like, oh, it sounds super interesting, keep me posted. And like that's the critique, which is also very true. And then ultimately like it progressed to the point where we had 3 firms really pressing in, doing the diligence, trying to get to the term sheet thing. And, from there got like 3 term sheets and ended up selecting Leflane as our lead investor for it. That process, like the pre-term sheet diligence was probably like 4 to 6 weeks. And then it was probably an additional 5 weeks of legal and confirmatory diligence after that to get the deal closed.
Okay. I guess this is a bit more for Alan and Brian. So how do you compare the difficulty pre and post COVID for raising funds?
Alan, do you want to go?
I can jump in here. I think pre-COVID, certainly fundraising meetings were mostly in person, and therefore the expectation was these conversations would start off as a bit longer conversations because people have taken the time to actually commute and meet together in person, and therefore it would take it was a higher bar to get to that point where you're actually talking to an investor, and it will also take longer to get on an investor's calendar. But during COVID, because everything was done over video, expectations have changed. It's no longer rude to have a 20-minute video call just to learn about each other. And because these meetings are also shorter, it's also easier to squeeze them onto people's calendars. So it would take less lead time, and you can talk to more people and have more touch points. And the benefits to the founder are that you can actually pack more investor discussions within the same week or within the same couple of weeks, where you're really trying to get as many interested parties together as possible and herd them towards closing at about the same time. So that has really worked to the founder's benefits. Now the flip side of that is investors also meeting with more founders during the same time as well. So strong follow-ups become really important. Getting investors interested, emotionally interested in the first meeting becomes even more important, because otherwise they will just forget about you at the end of the day. And also timing. So in our case, we time these fundraising conversations around the timing where we were expecting a number of deals to close on the business side. So we were able to, during the fundraising process, give these potential investors an update on how our business was progressing, to give them a sense of forward momentum, and as a way to encourage them to make a commitment.
Yeah, I think like if it's pre and post COVID, I think there's even like a lot of different timelines within there that I think if you talk about right now as, I don't know, during COVID or post COVID, I don't know what the timeline would be, but I think it's probably as easy as it's ever been. That Fed gave $6 trillion of stimulus. Like, all the VCs are raising just obscene rounds. The Fed funds rate is near zero, and so people are looking to increase returns somewhere, and they're going, further into like out the risk spectrum with venture investments and the like. And so the pools of capital are there, and people are paid to deploy it and put it to work. And so, the money's there, the appetite's there. Like, I think there's a lot of demand for venture investments now. And so I think it's relatively like as easy as it's ever been. I think like in the month or two post COVID getting serious, and people going work from home, I think that put a huge pause on things, just because of the uncertainty that a lot of the VCs had no idea whether they were going to have to support like their portfolio companies that were doing well 2 months ago that might go bankrupt or run out of cash in 6 months if they weren't supported. They had no idea if the markets dropped 30%. They don't know if they were going to drop another 30% or just like rebound to the level. And so I think that time period put a pause on everything, and was more like there was more ambiguity, which made it more difficult. That being said, I do think the fundraising process is so idiosyncratic to the company that is actually raising, and so it's really like stage dependent, industry specific, like who you're talking to and the like. I don't know if it really the like sort of macro trends of VC, I think, are like less of an influence versus sort of the micro aspect of what your business does, where you are, what kind of capital you need for progressing and the like.
Okay, great, thank you. Now, what advice do you have for those who might be raising their first angel round? What about those who don't have a strong network yet? Jacqueline, maybe you'd like to tackle this one?
Yeah, you can apply to an accelerator. That's one way to kind of get around that. I think compared to some of my classmates who graduated and also did companies and didn't do YC, it was tapping into the Stanford network, professors, friends and families, small angel checks that way. I think for a first-time founder, at a certain point, you have to expressly say, would you like to invest in my company? Before you say those words, I think that's where there's a little bit of a song and dance with angels and friends and family, where you're not like learning to ask for money is an acquired skill, or at least it's been for me. And that's where I think, making the explicit ask and, putting out the signpost, I'm raising money, is something that I don't think I did particularly well upon like leaving the GSB, knowing that I was going to start a company. Whereas like I know classmates who expressly said, I want to raise money because I am starting this company. Then people appear out of the woodwork and say, oh, I would like to invest in some sort of way. So I would say making it very known that you're raising money is probably the first step. And then literally asking exactly what you want is the other thing.
Okay. Now, have you found that specific industries have an easier time raising funds than others during the pandemic? Maybe Alan, you can comment on what you're seeing at Exceed, also in the Bay Area with the Stanford Angels and Entrepreneurs Group. And then Jacqueline, maybe you can share a bit more on what you saw from Y Combinator and what happened with your cohort there.
Yeah, so it's definitely any companies whose demand, they've seen an increase in demand because of the pandemic will have an easier time. So the obvious ones are the ones that are related to remote work, collaboration, video, anything, everything. But I think during COVID, the dynamics of fundraising with different industries has also been changing a lot too. So the most obvious use cases have been picked off, and these spaces have become super crowded. For example, there's an ever increasing number of companies that are doing sentiment analysis for video sales calls, right? So that's an example of a use case where, had you been doing that prior to COVID and you've seen your traction increase during that, you would have a great time raising capital in June. But if you're starting a company in that space now and trying to raise capital, it might be perceived as overcrowded already. So investor sentiments and the crowdedness of a space also changes very rapidly during this time, and also investors are currently looking at what's going to happen post-COVID, and that of course involves a little bit of trying fortune telling or looking into the future, which is always risky. But know that if what you're pitching is only relevant during this time or too closely tied to the pandemic, then there's also risk of not being able to raise capital, because investors want to know that they're not just investing in a company that is in demand right now, but also going to have a great outcome 5-10 years out.
Yeah, as far as my YC cohort, I don't think I can say broadly speaking who did. I mean, a lot of what Alan said, I think it is right. It's hard to say like across the board, certain types of companies or other ones. I mean, I would say I think the best advice I got is at least for us, like you just need one believer, or you just need a couple, right? And so I think it's pretty idiosyncratic, and you know, nothing is better than traction. So unless, I guess, COVID was obviously, maybe like travel and leisure is like kind of a very obvious category that was going to be negatively impacted for a while. And even, you know, Airbnb is kind of bouncing back in different ways. As long as it wasn't totally obvious that it wasn't going to be like COVID was going to stomp on it, pretty much, as long as you had some traction to show, like, and you had one really solid believer in your idea, that's what you need to kind of get your company off the ground. I think the considerations that you're facing at the seed level are probably very different than what you're building at B and C, but that's where I think it's more idiosyncratic at the seed stage where we are.
Okay. Well, thanks to the audience for sharing many, many profound questions and helping steer the discussion so far. While we apologize in advance if we don't get to your question, please know that we are taking note of all questions to guide future programming. And now I'll hand it over to Alex to moderate the live questions.
Thank you, Sheila, and thank you to our panelists for the fantastic discussion so far. Okay, let's jump into the questions from the audience. We'll start with a couple of questions submitted during registration. Vadim asks, how did you help people transition to distributed teams and remote work? And how does remote work affect your cost structure? Jacqueline, I know you touched a little bit upon this. Do you want to add anything to that?
Yeah, we were, after Y Combinator, fully intending on getting an office in New York, which is obviously, it's more expensive in light. We've only been a remote team, so I think we have really good muscles around documentation and task management in a way that's very, that's everything is written down. So I think in the past, I've worked at companies where there's a strong in-person oratory culture, and our company out now is very much trying to do asynchronous work because people are in different time zones, and do it in a documented way where we can like pass it off really easily. It also, I think, gives us the ability to hire across time zones as opposed to thinking of, who is in New York. And that also helps. I also think that some people, we have to be pretty intentional around creating water cooler opportunities that, like I said, most of my team has not met each other in person yet. And so that's taken a bit of thought in terms of like how we create those organically and not in a contrived, give people Zoom exhaustion. But I think overall it's net positive, as I just, we've had 2 employees move out of New York City to completely different parts of the country because we've kind of given them that flexibility.
That's great. Alan, do you want to respond to that question?
Yeah, when shelter in place started happening, we hadn't built up a large team yet. There was still a few folks of us. So I remember sending everybody home the first week of March. But of course, never knowing that we're going to be operating remotely still 6 months in. So we didn't have a lot of baggage that we needed to rework. And since then, we have added a number of team members, and we're now spread over 3 different time zones. And to Jacqueline's point, it's actually given us more flexibility in recruiting the best talent wherever they are, and also forced us to really develop these muscles around how do we operate as a distributed team, as a distributed company, in terms of creating water cooler opportunities for spontaneous conversations. for us, what's worked out well is less of a technology solution, but just building this culture where it's okay to drop a quick note to each other, whether it's like through your favorite channel, whatever it is, could be WhatsApp, text, Slack, or even just picking up the phone and giving the other person a call. And one, making it perfectly okay to say, no, I'm working on something, this is my focus time, let's chat in an hour. But at the same time, like, don't feel like you're interrupting, just reaching out. And that helps to bridge some of the gap where in the past you could just swivel around your chair and talk to a colleague to bounce some ideas off. Whiteboarding is still difficult. We haven't solved that problem yet. We used to whiteboard a lot together and creatively think together. So maybe we'll start investing in stylus for everybody and using Zoom to whiteboard together. We're still trying.
That's great. Brian, what are your thoughts on distributed teams, your transition to distributed teams and remote work?
Yeah, so I actually think the distributed teams like massively benefits newer companies versus old ones. And it wasn't that like it wasn't this like pre-planned thing, but everything that we've done is cloud hosted SaaS software and the like, that really all you need to run the company and do your job is laptop and internet connection. And that's just not true for a lot of the like legacy players out there, where they have a lot of like manual systems and on-prem, you know, hardware and infrastructure and the like that there is needed to run the company. And so for us, like, yeah, we don't need to be in an office together. And so we haven't lost like productivity. We can run the entire business from home. It's 100% digital, which is nice. I think we started the pandemic with 50 employees and have hired 30 over the last 6 months. And so we've onboarded a decent amount like into the company while 100% remote and haven't met face to face. I would say my like general take is it's probably better. Like the work from home is probably preferred on the whole from people who have work experience before. They like, it's less distraction. They can, you know, manage their own time a little bit better. They can, you know, work when they want to and have flexibility when they don't. It's in the comfort of their home. And so like that probably increases productivity. Where it has been difficult is just onboarding people who are getting their first corporate job and sort of the like transition from school work to corporate life. There's just like they've all done it extraordinarily well, but it's just harder to like pick up on the cultural cues and the training, and like even have a manager be as involved in the development and onboarding and coaching that happens with more entry level people.
All right, that's great. So Andrew asks, what are changes your team needed to make because of COVID that you would like to see continue in the post-COVID era? Brian, do you want to start off this time?
Yeah, so we've done the progression from like 6 people at my kitchen table to now 80. And so in sometimes when we were small, like everybody knew everybody, what they were working on. They like, you know, formed a like great working relationship with it. You got to like sort of the no look pass on all the work. And as you scale, you sort of like verticalize within different disciplines within the company. And so, you know, like operations talks less to engineering and the like versus, you know, all working around the same desk. The thing that like in COVID, sort of knowing that the like impromptu water cooler lunch conversations weren't going to happen, we use a product called Donut on Slack that just introduces like 2 people from different teams for a 30-minute, you know, donut coffee once a week. And it's a really cool way to say like, you know, like, hey, I also work at this company. What do you do here? And, you know, to talk about all the things and like meet on a personal level. And I think that's like beneficial. Then we will work to instill a lot of those things, even if we do go back to, you know, a primary office at some point.
Alan, how about you? What kind of practices would you look forward to continuing post-COVID?
I think we all recognize that not being able to see each other face to face requires us to over communicate, and that's actually something that we would love our team to carry forward, even when we can go back to the office together again, because that really helps to make sure everybody's on the same page, and also reduces the likelihood of miscommunications, misunderstandings, which leads to friction.
Okay. And Jacqueline, I know you started during COVID times. What do you think? Are you going to continue largely the same way, extending post-COVID, or what do you think? What do you expect to be changes?
Yeah, at this rate, our team is pretty distributed to the point where there's no centralized office location that would make sense. So I actually think we'll be a fully remote company, which would not be the way that I envisioned it 6 months ago. But I think, being able to asynchronously work and having the proper documentation and knowing who's working on what at any given time, that's something we've really harped on as like an early muscle, and I think has really helped us, and definitely want to continue that.
Okay. We'll now take live questions from the audience. This is to all panelists. Do you guys believe investors are lowering the bar for what acceptable growth looks like during the pandemic?
No, not based on what I've seen so far. In fact, they might be raising the bar because the companies that are most desirable are the ones that have been accelerated by the pandemic. So it's not so much giving founders a pass on, hey, you've been impacted negatively, it's okay, but more so them looking for the most compelling opportunities to invest in, especially the ones that have been accelerated during this time.
That's right. Brian, Jacqueline, do you guys have anything to add?
Broadly speaking, I don't know, where valuations are compared to previous years and on different traction stages. I would say the investors we deal with are quite sophisticated, and are for every investment that they make will do due diligence, deep diligence on 10 to 15, and see maybe 150, 200. I don't know what the exact numbers are, and they'll have done that over long periods of time, and so they know sort of being able to compare across similar companies, similar stages, growth metrics, and the like from a user by user cohort basis. And so it would surprise me if they have fundamentally changed things versus doing pretty sophisticated pattern matching to what has worked historically.
For Series A, which is, I guess, our next milestone, I've frankly gotten very different views on what the traction and numbers needs to be. And I think COVID or not, I think that's always been somewhat the case, is depending on the I mean, again, you need, depending on how you think about your cap table, you ultimately, want one really solid relationship with your lead investor, or a couple handful. And so I think it's as I've talked to my founder friends, I think the mentality of what is the traction I need to have pre-COVID versus post-COVID is kind of a counterfactual that doesn't really make sense for how you're going to run your business today. And I try to think I don't have a non-COVID world experience. That's not an option for this. And so we need to show growth and traction in a way that's that's fast, so that it's acceptable for venture returns. But at the same time, I don't really think about what they expect out of us. I think this is what we're presenting, and are you buying what I'm selling today? And if you can, afford to be, have longer runway by being prudent with the way that you spend, so that you can post better traction numbers when you go on raise. Those are the only things within your control. So I guess I don't spend a ton of time thinking about whether or not our numbers are going to exactly be in the realm pre or post, or how investor expectations, or how they're going to view that.
Okay, we have a question from Aditya for Brian. When evaluating different term sheets, is there anything besides valuation that matters?
Well, the nice thing is when you're evaluating multiple term sheets, there is a little bit of market sets the price. And so you have more negotiating leverage with valuations. And so you can get to, places where it's roughly similar. That being said, I would work very hard to take the term sheet from the investor that you are most aligned with, that you work the best with, that they're likely going to be joining the board, they're going to be working alongside you, they'll bring the shared resources. And we've been fortunate to have incredible alignment with how I and senior leadership think of the company, as well as how our investors do, and it just makes things work incredibly well. That this I can't imagine what happens. And I've heard horror stories from friends who have, board members or investors with a different theory of how to run and build the company that are like quite at odds, not sort of like minor disagreements. And I think it becomes like very contentious and difficult to excel at either one of the people's paths. And so I like the people who are on the board, I talk to every week, every 2 weeks. It's a multi-year relationship. It's, they almost act somewhat like co-founders to me. And so, having someone that you are like, that you work incredibly well with, have similar visions for, I think matter as much as valuation.
Okay. I think we have a time for one more question. This is from an anonymous attendee. As a founder who has raised institutionally and from individuals, introduction used to come from friends and via water cooler interactions. How do we network with and meet new investors totally remotely? How do we avoid cold outreach and filter through cold inbound requests from investors? Alan, do you want to get started with that?
So I've been able to really take advantage of our Bay Area chapter of Stanford Angels and Entrepreneurs. We have more than 100 angel investors in our network. And since I've been volunteering on the leadership team for the past 7 years, I know many of these members personally. So that was my base to start off with. And some of them came into the round, some of them made valuable introductions to investors that eventually came in. In addition, I had also been using Lunch Club fairly extensively to meet with new investors. And that's a low pressure way to test pitch your story, because I wasn't really pitching during these Lunch Club calls. I was just introducing myself and talking about what I'm doing. But by virtue of me being a founder and the other person being investors, naturally they want to see, hey, is this going to be a potential fit for our portfolio? And so that was a great way to expand my network, and also to especially in the early days of the fundraising cycle, to test different ways of telling the story to help me figure out what's the most compelling narrative to put together.
Brian, Jacqueline, do you guys have anything else to add?
Yeah,
Brian?
so in the early stages, if it's like angel, seed, Series A, I do think it's a hustle and grind. It's using your friends, your connections. It is cold outreach. It's trying to get on the investor's radar and sort of beating down doors to make it happen. And in some sense, like that's a little bit of the expectation of a founder of like that's what you have to do type thing. The nice I would say don't like over optimize for fundraising. Like as you grow the business, the world's best thing for fundraising perspective is strong traction, and investors are paid to go find the valuable investments. And so our Series B, which is when we've had the most traction and the like, we have an inbound interest just because of the state of the business. And so I think, the further along you are, the more traction, the more exciting things that you're doing just makes it massively opens up doors, and people will come find you, and it's easier to get people's attention. So I do think, most of the focus should be on just building the best business that you can be. And then, the secondary thing comes in front of getting the investors' attention for the capital.
Yeah, one other thing I'll add at the early stage is I think the best way to get in front of the investor is to have one of their portfolios, founders, introduce them. So that's another way to kind of comb through the Stanford network is, if there's a particular investor you want to meet with, who are their portfolio companies, who are those founders, and how do you network with those founders? And also as people have asked me for intros to our investors, for me, that's a very low ask. Because again, I'm, the investor's job is to find opportunities. And so for me to make that warm introduction is very, a relatively low ask if I know you kind of remotely well. So that's one way to get in front of them with a warm intro.
Okay, wow, this has been an incredible discussion. Thank you so much to our panelists for all the great insights. I will now pass it to Sheila, who has a few announcements to make.
Thanks, Alex. Thanks very much to our guests, Alan, Brian, and Jacqueline, for sharing your valuable perspective and time with us today. Before we wrap up, what's your ask from the audience? Let's start with Jacqueline.
I did not think about this one. I should have. I guess my main ask is if you at your company want to introduce me to your head of HR or people ops, that's the introduction I would love. My email address is my first name, Jaclyn, Jaclyn, @getbenepass.com.
Great. Brian, what about you? What's your ask?
M1 is a money management platform. We offer free investing and high yield checking. So I think our platform is better than what you use to manage your money. So go check it out, download it, try it out.
Great. And Alan?
Well, if your company or any companies you know or schools you know would like to use us to screen for COVID amongst their people, to very easily order at-home test kits for them, keep us in mind. The product is Fever IQ. Go to feveriq.com. And if you're also interested in using the underlying Enya.ai API for confidential computing, reach out to me as well. My email is alan@enya.ai.
Awesome. Okay, everyone, hang tight now. We just have a few parting announcements. First, entrepreneurs interested in pitching to angel investors, please share your business pitch for rolling consideration to saemidwest@alumni.stanford.edu. Second, if you're an angel serious about investing in high caliber startups, please email saemidwest@alumni.stanford.edu to find out about angel membership with our group. Thanks very much for joining us today, and we'll see you again soon. Goodbye.